Hi all and welcome to Under the Radar. This is a corner where we discuss stocks that have been once upon a time Wall Street darlings, and then something happened and they're gone. So maybe the company is still alive, but the stock that used to be day traders paradise, Wall Street darling, investors bonanza. You pick the definition. It's 99 or 90, sometimes even more off its highs, and it's no longer part of our daily routine. Sometimes we don't remember the symbols anymore. That's almost the case with this company, Red Robin Gourmet Burgers. That's a stock that was the darling of Wall Street. If we look at the 5-year chart, so that was when was it? The last high at $41 in during COVID, I think, during COVID. And since then, the company went not belly up, but take a look at this horrible 95%. So yeah, 90 from 40 to as low as $2. Yeah, that's a 90% drop in the value of the company. That's kind of ugly. Now, if you look at the 5-year chart, keep in mind that the stock was at $1.7 before $7 before it moved up 500% or 600%. So those moves in the stock are clearly. This is a volatile hamburger chain. It's not only a gourmet burger. It's also super volatile and insanely moody, let's call it. So, who are the owners of RRGB? Not the public. 70%. If you go to Yahoo Finance and you press holders, you'll see that still up to date. 70% of float is held by institutions. That's actually a positive thing. So because those guys are thinking long term versus the general public. Definitely day traders that are looking for a quick buck and then running away. That's our business. Quick buck and looking for another stock or another trade. So after the earnings that came out on Friday, way better than expected. You can see here on the chart, that's a daily chart. You can see here the operating revenue and EPS, and it doesn't matter. The real number is here. Take a look at this absolute winner. Hold on a second. Up 63% at the close on Friday versus Thursday's close. So earnings amazing, way better than expected, surprising everybody. The volume in RRGB, the best ever or the best in 5 years. The stock did not sell off, so it went up 70%. Of course, there was some profit taking, but overall the stock held amazingly well. Now, what about day traders and small caps? Is it worth even looking at small caps as a day trader if you have so many amazing opportunities in the large caps or mid caps? When I say large caps, I mean price-wise, not necessarily the value of the company, because Nvidia was $1,500 a year ago. Then they delivered a split, and now the company, the share value is only 150. The company's value did not change. So, but NVIDIA trades 300 million shares per day at 140 right now. So if you can trade NVIDIA and you don't have a problem with your leverages, and you can trade 500 shares of NVIDIA as a day trader, not as an investor, and you can trade it with a risk of let's say 20 cents if you're smart. So you risk 20 cents on $500 shares is $100, and you want to trade 500 shares of RRGB. The risk is not going to be less than 10 to 15 cents, sometimes even 20. So this is a $5 stock. The other one is a $140 stock. How many times a day you will deliver a $50 to $1 move in RRGB versus NVIDIA? And the answer is never. You're not going to get a 50-cent move in RRGB intraday. I don't want to say ever, maybe once a year, but it's going to happen 3 or 4 times per day in NVIDIA. Of course, you can lose the 20 cents. But so point blank, no reason at all to day trade small caps. The only ones I'm guessing that are day trading small caps, those are small accounts. They, for whatever reason, think that there is any reason to day trade small caps, because again, you cannot deliver a good risk reward when the range is so pathetic. And again, if you watch the range in RRGB, other than the first 10 minutes of action, the range wasn't spectacular. But again, who can expect a big range from a $5 stock? So if you want to summarize what happened here, sometimes the chart, and in this case we look at the daily chart, is sending a message. Let's take a look at year to date. Okay, so that's the year to date chart. Take a look at this bold message from RRGB. First of all, 70% gap up, and let's call it a gap up and go. It didn't close at the highs of the day, but the volume, guys, if you look at the volume, this is going back 5 years. I think I showed the chart already. This is the biggest volume bar going back 5 years, assuming this chart is correct. Okay, so we have here a mega event, huge volume bar. I mean, not 50%, 100% more. This is 1,000% more pickup in volume. Then, the stock has seen volatile days before. I don't think nothing compares to this one. So the question is, if you are a small cap trader or want to diversify a bit into small caps, what's the best strategy? So for day traders, I think this is not a good idea. You don't want to day trade small caps. It's just not worth your time, and the reward is going to be minimal. So the risk reward is actually, I don't want to say negative, but it's totally off balance versus the market leaders, not to mention a good day in a market leader. And this is where we're going anyway. So day trade, no. What you can do is a swing trade. And those who are familiar with the swing trades know that there's the increased risk holding positions overnight. When you swing a stock, you first day trade it, enter the money, so you're profitable by the end of the trading day, and you carry all the position or some of it, depends on your personal strategy, into the second day. Second day works out, you go into the third day, and so forth, and you elevate your price in the money after a couple of days to lock in profits, and you hope, and you need to be aware that there are no earnings coming, and this in this case this is not coming. There are no earnings around the corner in RRGB. So if to day trade RRGB, I would say no. If to swing trade RRGB, it can be I don't know what's going to happen on Monday or Tuesday, but needs to be followed, and it can be a great opportunity. I mean, the stock is down a lot. There is a huge signal on the daily chart. I don't know if there are any important, let's call it analyst or any important market moving institution or website, or Bloomberg or Barron's or CNBC will pick it and write about it. So it's going to be important as well, because many many investors and traders and swingers and everybody that reads the media over the weekend can pick up we may see a continuation here, just because the hype of this surprise excellent move, and it carries some qualities with it, and first of all, the earnings, that's a fundamental piece of news. Then two technical indicators that are working here is the increased range, and more important than that, super pickup in volume, meaning institutional traders bought into this earnings report. About continuation, we'll see. I mean, 67 or 62% pickup also calls for profit taking. Anyway, I hope it was interesting enough to take 12, almost 12 and a half minutes of your time, guys. Thanks a lot for being here with us. Please remember to write any comments if you have, and we'll see you in our next video.